GetCrack. Wake up, motherfucker.
All right, what's up, guys? All right, so June, we're in June now. All right, let's see what's up here. Let's see if I get whatever I need to get. Okay. All right, let's see. Hmm. What to start with? I got some stocks to discuss, huh? So HP Enterprise just released earnings. What was it? 30%. I saw after hours. Okay, that's good. That's good. What else to discuss? Hold on. Let's see. Let's see. Blah, 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 blah. Some images, huh? Okay. Put these images on there for the screen. Let's look. Doot, 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 doot. Okay. All right. Let's go. Okay, so this image is interesting. So, well, let me show you this first. Remember the long presentation with a Canadian guy, and he was complaining about the interest rates, right? He was just like, "Oh, interest rates don't affect these things no more. Interest rates don't affect these things no more." Okay, so interest rates went back up today. I'm not sure if it's all-time high or not all-time high. I mean, the high of the year, but it did go back up. And I did notice like some sectors, right, took the hit, the sectors that he cared about. So let's review that. So let's review a little bit here. Doot. Okay, let's go here. Put the screenshot up. All right. So let's look at the sectors. So what sectors matter when interest rates start going up? KRE. KRE is the ETF for regional banks. Regional banks make a lot of one other area of the market, small caps. Regional banks tend to be small cap stocks. So IWM, so KRE is part of IWM. Another one that's not listed here are the biotechs. So those also will tend to go mid cap, small cap. So IWM again probably has combinations of regional banks, biotechs, and then they also have other things too, but we're not going to discuss them. But these are the most sensitive with interest rates. What are the other ones? Real estate, REITs, REITs. So the IYR, I guess he picked that one as the ETF for that. There are other ETFs. There's a Vanguard one, real estate, VNQ, I think it's called. I'm not sure. Don't quote me on that one. The other one is XLRE. So those are also. So I don't know why he picked IYR over here, but I guess he picked IYR. All right. Not really sure if one's better than the other, but yeah, there are other real estate ETFs. Then he goes on to pick XLU, utilities. Okay. Then we have Staples, XLP. So these things are sensitive to real estates, right? So we had a little pop on the interest rates today, and these things went down today. And then if you look at tech, overall tech, what do we see? Software continued up. All the stocks I talked about last night went up, totally ignoring anything the interest rates are doing. We saw some weakness in semiconductors after the release of the new NVIDIA ARM processor. And so Qualcomm went down because it's a competition against Qualcomm. Intel went down. It's a competition against Intel. AMD also went down for a little while, but it recovered today. But overall, semiconductors, I would say, ignored it as well. So interest rates, the war in Iran, oil, they seem to only affect certain things, right? And he was complaining that overall this year, it's not affecting those things as much. But today we did see a big effect from the fact that there was no, deal coming soon. So it is starting to affect them. Now you would think like, oh, so what's causing it this time? So why didn't it affect it that much since the start of the war in March? Like these things should have been negative. Why are they still positive then? They've been ignoring it, even though the Strait of Hormuz is closed. Nothing has changed since the ceasefire started. What has changed? Nothing. Oil is still high, right? Of course, it's not like as high as the peaks, but they're still high. They're still elevated levels. We're not seeing like $60 per barrel oil anytime soon. That's not going to happen. Food prices are going up, so inflationary pressures are going up. You can't tell me all the inflation data will just disappear, and all of a sudden, when oil goes down, all that inflation will just go back. No, it takes time for that inflation to go away, even after oil just slams back down, if it even slams back down. So, how come, right? How come? We have a new Fed chair. That could be one reason. The market doesn't care about any of this stuff until they hear the Fed chair, and they think this Fed chair will be very accommodative. He's a Trump pick. He'll listen to Trump. Maybe that's the reason. I don't know. So there's a lot of things that we won't see, right? We won't fully understand. That's kind of the question we have to ask anyhow. So hopefully you get the idea. That's why I don't focus on the fundamental stuff. Uh, the fundamental stuff may affect things or it may not affect things, and it takes time to cycle through. But we did see a warning shot today. Um, so there definitely was something happening today. So let me get going here. Let's see, what's the other one? What's the other stuff to discuss? Okay. What's the other stuff to discuss? So let's look at what happened with the Anthropic um, filing. Let's see. Is that important? Is that something to talk about right now? Should we discuss that right now? Let's see. Anthropic. So we have a S1 form filled out. So they submitted this to the SEC. Okay. And this guy made a joke about it. He said, okay, ARR is 47, what is that? $47 billion. Net income, a loss essentially of $5 billion. Then he said, magic negative number, -1. The PE ratio is 300. If we just do -1 times that, we get -300. And then we get our valuation of $1.5 trillion. So he's making a joke. Okay. He's like, how come this company is worth $1.5 trillion? It makes no money. And a lot of these companies right now that are going up make no money. A lot of these software companies make no money. I don't know, Doc N, probably one of them. Hut. Well, Hut is not really software, but I think it has a hard time claim that it makes money. Okay. What else? I don't know, CrowdStrike and CoreWeave and Cloudflare, are those guys making money? They're all about growth. Okay. So a lot of these companies are valued on growth. And so I saw another chart where some guy was saying like the stocks that make no money, no profit, essentially, okay, no profit, have over the past month gone up 200%. So if you put all the stocks in the stock market of all the companies that make no profits, they've gone up 200% right now. So yeah, we're definitely in a bubble. We're definitely in a bubble. So I said, focus on those companies because they already ignore fundamentals. So why do I care about interest rates? They already don't care that these companies make profit and they're willing to overpay for them, right? Oil companies make money. Gas companies make money. Why don't I buy Chevron or Exxon? They still make money. Even if oil goes back down to $80 a gallon, $80 a barrel, still makes way more money than Anthropic. That's not the point. You see what I'm saying? That's not the point. So I could scream, yell, and complain about fundamentals, 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 and go like, interest rates go up. These stocks should go down. They're not. And worst of all are the software companies, semiconductors, all these companies that are moving up and ignoring interest rates. And software companies are the most egregious of the violators of fundamentals, right? They make absolutely no profit, unlike a lot of semiconductors do. Yet they command a huge premium to buy their stocks right now. And as you can see, since last week, the last several days of trading, we've seen Oracle pump up. We've seen CoreWeave recover. We've seen MongoDB. I don't know. What the heck is Mongo database? What does that company even do? Today, it went up like 15, 20% or something crazy. And I talked about it too, like what, last night or Saturday night? And I said, well, the chart looks ugly, but the earnings results, I have a feeling, dirty feeling that this thing might pop. And today it popped up. So yeah, you just can't use fundamentals in this kind of market. You're just not gonna, it's not gonna work. It's just not gonna work. Oracle has relatively tracked with BTC moves until the last, yes, correct. A lot of the software, IGV, used to track and correlate with Bitcoin very closely. It's the same type of investor, right? People that invest in quote unquote the future. They don't care about what's happening now or how, see, Bitcoin, how useful is it now? They're just caring about the future. So people that are very forward minded, that like to invest in things that have wild claims about what they could possibly become in 20, 30 years. That's what it is. So it's like a lot. It's you can look at it, treat it like a bond, something that you buy. And actually, I talked about this before, and I think if I just Google this, the AI will give you a better explanation. But it's kind of like a bond. So when you buy a biotech company, you buy for the technology, the drug. So a small biotech company makes no profit. It's not like a Pfizer. It's not going to be a Eli Lilly. It's not going to be Novo Nordisk. It's not going to be a big pharmaceutical company. A small pharmaceutical company that relies on one or two drugs, a special kind of technology, very risky, right? Like Moderna. Before COVID, Moderna was just like some kind of technology that they bet on. And only until COVID did they get relevant, right? So they got lucky. A lot of companies, they would have to require you to get FDA approval, and those takes many years. And if they're lucky, they get like very good results on their trials that they don't need to wait for FDA approval. A bigger company will buy them out, and you get payout from that. So you can think of it like long term, very long term. Takes many, many years, and there's no guarantee it doesn't go and crash to zero. Many of these companies will just go to zero, technically, because they dilute the share, right? So the old shareholders, they keep diluting it. The price keeps going down, 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 and then eventually they just split, reverse split, reverse split. But if you're a long-term shareholder, you would just lose money, right? You bought it at $20, it goes down to $1. They reverse split it back to $10, and then they keep doing, it goes down, down, down again, back to $1. They reverse split. This happens all the time with biotechs. So Bitcoin should be looked at the same way, right? And a lot of these software companies, Zscaler, whatever, they might look very attractive, but they also have the same kind of mentality where, you know, you require that they don't have a competitor, they don't get slammed because of some bad news. This happens a lot as well with these software as a service. AI is basically that. AI is like kind of going around as a wrecking ball and screwing with a lot of these companies. And interest rates are very important because they require loans. Since they don't make a profit, they don't have a huge free cash flow like Google or Microsoft, right? like a big software company has huge cash flows. So a Google and Microsoft, they can waste a lot of money, spend a lot of money on research and development. These smaller software companies, if they don't make profit, they're really reliant on trying to issue more shares or get more debt. And if the interest rates are very high, guess what? They don't want to get more bonds, right? They don't want to go into the bond market and try to issue corporate debt that way. What they do is they will release more shares. And so today Google released shares to Berkshire Hathaway. So Berkshire Hathaway will get some shares. So Google is now um, giving more shares out. Okay, so they are now issuing more shares. Berkshire Hathaway gets a discount price. Everybody else gets a shit price. So that's interesting. That means Google is spending so much money that they have to do this. So right now, we are starting to see these bigger companies start acting like small little biotechs, issuing more shares. Luckily, because Google is so, well known, so popular, it's not going to affect their share price. But eventually, if a lot of these big companies start doing this just because they want to build more AI data centers, um, it's going to blow up, right? If a lot of people don't want to use AI because after they charge money, right now AI is cheap because they're subsidizing it. They won't charge you a huge subscription fee right now. But later on, with all these tokens, we've been reviewing the token stuff. It's going to come to a point where people just don't want to spend the money on AI. They're going to realize what's really useful to me. Is it because AI for me is just a toy right now? I'm just using it to draw some thumbnails, make some goofy little images, maybe do some searches, in-depth searches, but most of most of the time I barely use it still, even now. I know, like, yeah, Universal Jones has used it a lot for his work to streamline things. So I'm not really sure uh, outside in the real world, what's the what's the actual use case where people are willing to pay a certain price to use AI, right? That should be it. Manufacturing shares should be outlawed. No, I mean that's the game. That's the game. That's the stock market game. They can do whatever they want and dump shares to the open public. So right now we're okay. IREN has did it. Hut hasn't done it, so we're still okay with Hut. IREN's kind of recovered. I'm sure CoreWeave probably issued some shares. That's why its price is so bad. Blump produced an Israel taco today, right as oil and rates were ready to run. Man, dude, I don't know. That's just noise. Like, you can't trade that shit. You don't have insider knowledge of what he's gonna tweet or what he's gonna say or what the newspapers are gonna say, right? The newspapers are already ahead of that game and they release rumors ahead of you. That's not the point. That's why I said focus on the software. Focus. Did any of the software care about what Iran is doing? No, absolutely not. IBM went up, everybody went up, ARM went up. Software semiconductors did not give a crap. You stick with the areas that don't matter to this. If you were in utilities, if you were in real estate, if you were in staples, yeah, you saw some trouble. So that's why everything here you see has some trouble. So let me remove all this. So let's get to some of the charts here. So very quickly, let's get to it. So you see even Bitcoin, right, fell. The rate increases affected Bitcoin. So Bitcoin took a hit from that. So some things are getting affected by it. Some things, gold, right? Too. Gold gets affected by it, right? So if you look at gold miners, yeah, it got slammed back down a bit, but it got support. The gold miners here is still 84. GDX is still support, but you can see, like, why do you want to play this when you got Hut to play with? You got other things to play with. See, Hut's up was up like 7% for a little while. Yeah, so there you go. It's like why do I bother with other things when we see better things? And so you got to watch out this week because we have CrowdStrike and we have Palo Alto Networks earnings. So I think CrowdStrike is tomorrow after the close, and Palo Alto Networks is going to be Wednesday or Thursday after the close, something like that. Let's see. Yeah, Wednesday after the close or Tuesday after close. Oh, so Palo Alto Networks. Oh, let me double check this. Let's see if I trust TradingView. Let's see. I got this other one. Let me look at this data here. Okay, Tuesday, Palo Alto Networks. Okay, verified. All right, Palo Alto Networks is Tuesday. CrowdStrike is on Wednesday after the close. So this is probably a good time to take profit. Honestly, I'm not going to be greedy. I'm out. Now, if this thing pulls back after the earnings, these two guys pull back after earnings, maybe I'll come back and I'll do leverage this time around. But personally, like I said, I I don't want to do risky leverage on these single stocks. All right. But I showed you that this is way better than doing the other ETF, right? Like SkyU. SkyU is the ETF for the cloud ETF. But this week it looks like it's going to go up again. So last week it was up 17%. This is 2x leverage. So SkyU, this one's up 14 right now after today's move. There's also another one I forgot to mention yesterday, Cyber UCyb. So this is UCYB. This is leverage cybersecurity. Again, I didn't talk about this one because I would think if you wanted leverage, it's better off you did Cloudflare and Palo Alto Networks. If you just did this ETF, you probably wouldn't get the maximum benefit, right? Because if I did CRWL, like CrowdStrike leverage here, let's see. Let me do my measurements. This thing from the bottom to the top is 300%. So if I did SCYB or UCYB, let's see. UCYB. Okay. Let's see what I would get. Yeah, 130%. See how lame that is? So that's why I didn't talk about it. Why you need that. Um so I'm out. I'm probably gonna be out tomorrow. I'm getting out. I'm done with the cybersecurity stuff, those two stocks for now, and I'll come back later to see. I'm not going to take the risk. Up to you. You guys, if you guys were in this and you want to take partial profit, like you just take a little bit off the table, like maybe you were selling along the way up. I don't know. And if you already sold along the way up, maybe you'll just risk the rest of it through earnings. But like I said, a lot of these software companies, the earnings are really crazy, right? This could drop like 50% when they got bad earnings or something. And you're just like, what the hell, dude, bro? Jeez. Yeah, these earnings on these software companies are insane. I use AI all the time for research, also coding. Yeah. So I'm not the target demographic. I'm just a retired guy that. Yeah. What's up, Ugg? Only thing that tanked was space, hoping. Yeah. So that whole explosion from that Blue Origin killed it, man. That really killed the momentum. I think yeah, once you did this last week, this whole chart like kind of sucks now. And I think it just started dragging down the other guys. So ASTS has a direct problem with the explosion of Blue Origin because ASTS uses Blue Origin to ship their satellites into space, right? Launch their satellites into space. But it spilled over to Rocket Lab, LUNR, okay, Intuitive Machines, and we have earnings for PL this week. So I think this is Thursday. PL will have earnings this week, but it's this one hasn't taken a lot of damage. So I'm really curious to see how it does on earnings. So I think it's Thursday or something, right? Thursday after the close. So if this thing survives and the space stocks move up next week, then that's probably a good dip to get into all these things if you're not in them already. So if you've been waiting to get in or you want to do leverage, so then maybe this is your chance to go like, all right, I'm going to switch out all my shares, go leverage for the final week into SpaceX. So next week, right, we're going into SpaceX IPO. And I have an article to read about that, right? So the IPO will be the 12th. So next week, Friday, on the 12th. So hopefully this gets cleared out. I mean, blame Jeff Bezos. It's crazy. It was like the largest explosion in space history. Like it blew up so big that it damaged a whole bunch of facilities around their launch site in Florida. It just took out a whole bunch of buildings, damaged the towers. So really bad, really bad. So it's too bad, it's just too bad. I wonder if they did it on purpose. Somebody went over there and hacked it and blew it up on purpose. So there you go. Take profits on what? The cybersecurity stuff. So if you're in cybersecurity, that's a lot of profit right there. I mean, in 1 month, you go up like 97% on shares, and if you're leveraged, you're up like 2 to 3 times that much. Yeah, I think you want to take profit. That's just not normal. I mean, if you think like you could just keep going another 100% without any breaks, okay, up to you. Up to you. I don't know. Damn, you got a clip. You guys don't know? It was all over Twitter and the YouTube and social media. Yeah, I have a clip of it. I didn't think it was that important. I thought it was just like, oh, well, something blew up. Who cares? Why does it matter with Rocket Lab or anything else? Rocket Lab has nothing to do with Blue Origin. Uh, so why would I give a crap about it? So I didn't think it was important. But it killed the whole momentum, and then everything started dragging down. And like I said, everything's with the options and the ETFs, right? So a lot of people, they buy these space stocks with the ETFs. So if one stock started dragging it down, it was just like everything starts dragging down with it. And today we got some confirmation. So let me before I forget, the thumbnail of the stream today was about this. Okay. So I think we have our explanation for what happened Tuesday. Okay, so last Tuesday, remember the big drop on pre-market from Micron and NASDAQ futures? So Micron is trading more premium, and he miswrote here, not that. Okay, so it's trading more premium than SPY and QQQ combined. So that means the options for SPY and QQQ, the most popular NASDAQ 100 and S&P 500 ETFs, where people trade options a lot, okay? Micron has beat out all of them in terms of popularity. So people are paying a lot of money to gamble on Micron options compared to the SPY and QQQ. So the only thing beating it is the SPX. SPX meaning options on the actual index, okay, which then affects the futures. So SPX has an index option. So that's different from ETF and single stock options. All right. I've probably rarely talked about the distinction here, but there's a big distinction with that. And the SPX informs the VIX. So the VIX options derive from that. So yes, SPX is more important than the ETF and the single stock options, but they all expire on the third week of the third month. So in 2 weeks, we will have everything expire for the quarter. So that's when all this stuff really matters. So the last time we saw a single stock consistently do this was July 2024 with Nvidia. Do you guys remember what happened in 2024 of July? That was the yen carry trade. And so we had a huge setback in tech because of Nvidia that time. So let me just look at the QQQ for you guys again, and then refresh your memories of 2024. So let's see. Okay, this was April 2024, right? So this is July. Yes, this drop here. So this was all because of Nvidia. 15% in 3 weeks. All right, basically 3 weeks after making a top here, July 8th. And that means it was after the end of the quarter, the end of the second quarter. So I'm really curious now, right? So whatever is going to happen, maybe it'll just be July again. It'll just be like they wait for everything to clear out for the quarter. So the final trading week of the quarter, then the first week of the July trading, we get like a little sideways, kind of like teasing that we can go higher, and then all of a sudden, puke all the way down. You think that's what's going to happen again? So they're going to wait for everything to clear out for the quarter and then wait for the first week of July to do this? Rug pull? Possible. Quite possible. And then this time it's not Nvidia, it's Micron that does it. So that means the South Koreans. So we got to really look at the South Koreans by the time we get to July. I think something's about to happen over there, right? So yeah, so that's what's going to happen. I'm guessing. So let me see if I got like an image of that. Man. And then I'll try to find the clip of the explosion for you, cuz I did download it. I thought it was pretty cool. It was an amazing explosion. It was basically like if they did that for the Oppenheimer movie, that was like, dude, that's a mushroom cloud, bro. That's straight up mushroom cloud. Okay, so this is a picture here from Twitter. Oh, not just Korea. US spot to vol correlation, okay, back to October's record highs. And then if you look here, the Korean index, the Kospi, is going up with the VIX. Again, we talked about like the options, right, going up with the VIX. The gamma was flipped, right? The whole curvature got flipped over. And so those nerds over at Vol Signals was saying like, yeah, the market will go up with volatility. So the Koreans already have a very exaggerated volatility is going up and their index is going up. And then for us, we see the spot to vol correlation is right back up to October high. So we're also in this issue now where volatility is going up, but the stock market is going up. And so the last time we had this was in October. All right, so let's see what happened in October then. So what happened in October? What's so important about October? October, actually, we had a little drop in October, didn't we? So right here, we had a top into Halloween, and then November we crashed. Interesting, isn't it? So we waited until the end of the month, and then we crashed. And this wasn't the end of the quarter, okay? So, but October is a pretty good month where you have things happen because a lot of hedge funds, they close out all their accounts by the time we get into September, October. Most hedge funds are completely finished by that time. November and December are very quiet months. Everybody's going on vacation. All right. They're going for Hanukkah, Christmas, Thanksgiving. Not much trading goes on during November and December. So they try to wrap everything up. So during this time, we had earnings. We had some earnings come out, right? And then after that, it just sold off. So we're at this point now. I think like we're going to go into July, and then sometime in July, we'll just start going back. So if we don't get a top in the coming 3 weeks because of Kevin Warsh, because of the options market closing out everything, expiring at the third week of the third month, or SpaceX IPO. If none of those things really does a lot of damage, so let's predict this. Let's say we go up a bit more, we start going sideways, because of all the noise, and then we go up a little bit more at the end, the last week of June to the first week of July, and then that's when we just puke and just go down. It's just like it just gives up, you know. That might be what's going to happen. So I would say that this is your kind of clue. Okay, so sometime in July here, this is when it's over. So probably Nasdaq and SPY will just go sideways. Some stocks will continue to go up, right? So we can look for HUT. We'll just look at Rocket Lab or whatever. Hopefully the space stocks can continue up next week. And then we have the software like Oracle and whatever. Oracle will report earnings in June. So we have some time before Oracle reports earnings, but a lot of the software companies have already reported earnings. So, DocN is done. Okta is done. All these guys, like, man, DocN is 11% today. Okta is like, what, 14% or something? Crazy, crazy, crazy. Yeah, 13%. Crazy good stuff here. So, yeah, there's a lot of opportunities still in the coming few weeks. Oh man, Zscaler, man. After earnings, it got beat up. I guess I can't do Zscaler. Forget Zscaler then. And then we have Now, Cloudflare, Net. So ServiceNow. It looks like this one is trying to recover a bit, but it doesn't have a good up chart, right? Like DocN or whatever. Net. Let's see, Net, right? Net. Let's see if we can break out and confirm it. So right now we're above the top with 12% on Net. So once we're done here, we can just go as high as we can. We're good to go. So there's a lot of stocks out there. Why do you need to look at other stocks except for these, right? Forget about everything else right now. Just follow these into July, the first week of July. So hopefully we can do that, and then we're done. What is a spot to vol? Spot to vol. So what they're saying is that the individual stocks compared to the individual volatility is going up. So it's kind of a repeat of what we showed with that presentation of the nerd. So he talked about like, oh, VIX is going up and this, and I'm like, what are you talking about, bro? I'm looking at the VIX. The VIX is going down. The VIX is going down. I don't see what you're seeing. But then the other dude had the presentation. Oh, there's another VIX. There's a VIX EQ or whatever. Oh, the VIX EQ. Yeah, the VIX EQ is going sideways and starting to go up. Okay, so that's what I thought. I thought those guys had a different VIX. See, this is the problem when you don't have your own options data. You're dependent on being given a lot of this options data for free. So, oh my God, there's a lot of people here. And then there's the Core 3M. Remember that guy? He was talking about the Core 3M. Yeah, there's a Core 3M. Let me see if I can find it. Core 3M. Looks like I'm gonna have to Google this one. Okay, let me Google this. Holy shit. Core 3M ticker symbol. CBOE. Okay. Actually, maybe I can find it this way. CBOE colon VIX 3M, no. Core 1M, no. Where's the Core 3M? There you go. If TradingView doesn't have it, then oh, here it is. All right, Core 3M. Okay, and then the other one was what? Dispersion. CBOE. What the heck was it called? Dispersion. Bro, really, I don't want to learn this stuff, man. This is like a waste of time. I just want to look at a chart and figure it out from there. Why do I need to look at all these miscellaneous signals? Core 3M. Oh, okay. Well, where's the dispersion? I already got my Core 3M. Give me my dispersion. Man, I'm just gonna Google it. Forget this. Dispersion. DSPX. DSPX. Okay. I got dispersion and I got Core 3M. Am I gonna get the same stuff? What am I looking at here? Oh my god, what is this? Oh, bro. Man, this data is so dirty. All right. For no, okay, only close and open. How about that? No, only close and open. Piece of crap. Just draw a line. Okay, good. Okay. So the last time we were this high was July 2024, and then the last time we were high was June of 2026. So this was the same chart I showed in the other guy's video, right? And then, so if you look at back at the tweet, it's pretty much the same kind of picture, sorta, right? So we were up in July, and then we're up now. So you're gonna have to do your homework. You're gonna have to do your homework because I'm not an expert on any of this stuff. I'm not an options guy, but you're gonna have to learn this to figure out, whoa, where is the problem gonna be, and when is the problem gonna happen? You're gonna have to watch this thing and be like, yeah, I see a problem. I see a problem here, right here. There is a problem. So there we go. Now you got it, huh? So that's another way of getting the same kind of data, I suppose. I guess they're similar or they're related somehow. Yeah, there you go. Just a periodic correction or a bubble pop. Well, you don't know. You won't know until it happens. I don't think it's a real bubble pop though, because there's going to have to be a lot more signals for that to happen. We don't have all the signals that would say this is a big thing. So the last time this happened, it was just a correction, but it was a deep correction, right? It was 15%. 15% is scary for a lot of people. A lot of boomers will freak out. If you see 15% in 1 month, that is very scary, right? When we had the tariff stuff, that was like what, 20%. COVID was 30%. So in 1 month, those things were happening in 1 month. So for a boomer, that's scary. For anybody else, it's kind of like a normal office day. It's just like buy the dip time. Okay, but you can make a lot of money going into the bubble and getting out of the bubble at the right time. And if you short the bubble, you make money both directions, right? And so that's kind of the game we're doing. So that's why I said, like, this is a good time to practice. You can practice now this stuff. It's not that hard yet to play the game. It's going to get harder if we actually get into a 2022 type situation. That's when things get really bad, right? That's when things get really bad. So you don't want to be here. This is more difficult. This is more difficult to trade. Okay, this is a more difficult time to trade. When you had the Ukraine war, you had the interest rates go crazy. It didn't go down in a straight line, right? It went down, up, down, up, down, up, down, and every up move was quite violent, right? So this one was about, let's see, this first up move was 10%. This was about 10%. This one probably about 10% too. This one was longer, a longer up move. So this is probably 20 something, right? Yeah, 20. Okay, pretty much 20. And then this one, the final one, was 14 before we calmed down. After that, we started calming down, right? Like you can see, like, yeah, we started calming down. We started building this range. So instead of going like up, down, it was just like up, down in a sideways manner. And then once you got to March, that was the end of it. Once you got this March action here, you see the volume coming in March and then pushed it up. And then we started getting calmer. Now this range started being calmer. And then after that, we recovered. It was over. The bear market was over. You kind of had this little like correction here. People were like, "Oh man, there should be a recession. There should be a recession." But after that, it was over. All the people that wanted a recession, that called for a recession here and here, they got blown out of the water. You never heard them again on CNBC. You never heard them again. Anybody that said that shit on CNBC was over. What's up, Xian? What's up? Yeah. So hope you understand. Okay. You don't want this. You don't want this kind of market. This is not a good market. So hopefully it's not like that. The other worst case scenario, it's gonna be like 2007, right? I don't think it's gonna be 2007. We're not there yet. We're not in 2007. 2007 was crazier. That was crazier. This thing. No. See, it starts off like it was 2022, right? So see, so once you start like going down, it looks like 2022. This is like kind of like 2022. It's controlled demolition. We're going down in a nice manner, up, down, up, down, up, down. But then you had Bear Stearns going bankrupt, all this stuff going bankrupt. Bye bye. That was crazy. This is crazy. No. You don't want that. This is okay. You do this is fine. This is like 2022, okay? So you go down in an orderly fashion, no big panic. No big panic. This is a big panic. That's when the Fed has to step in and solve the problem. So, yeah, you don't want that one. Okay. Now this other stuff here, you see this one? This was pretty good panic here. This was like the end of 2018. Yeah. So we might have that coming down. This might happen. This thing might happen in uh in August. Something like this might happen in August. So you might have to watch yourself. It's gonna start off looking like, oh well, it's gonna be fine. We went down 20% or 15%. We're cool. We're gonna go back up. And then it does this before shitting itself again, like in Christmas. That would be crazy. I don't know. That's a possibility. That's definitely a possibility. But there's no signals that tell me that that's going to happen yet. I need more signals, okay? So if you guys remember like the what was the one I was telling you guys, the 3-month yield minus the 2-year, that one will be important for us to watch. That'll tell us how bad things could potentially get. If this thing breaks, then at least we'll have like a 2022 type situation. If this thing really breaks like down here, if we really break this, okay, if we really break this line and we start sinking, then yeah, we could have like a 2022 type situation, kind of a deeper correction. But if it doesn't break, then I wouldn't worry about it. I wouldn't worry about it. If some other signal starts triggering, then maybe I'll say it's going to be like a 2018 type situation. If more signals come in, then maybe I'll be like, oh crap, it's a 2007 type situation. But we don't have those things yet. Right now, all we can say is going to be a repeat of July of 2024, something, or a tariff tantrum type correction, right? On April of 2025. That's all we know for now. So that's probably in the works, but not yet. Well, if it's game on until July, I just need to pull back the game. It's yeah. Well, I don't know. I don't know what pullback you'll get. You might get a pullback at the end of 2 weeks, right? The end of maybe Kevin Warsh, but who knows? That's not a guarantee. That's not a guarantee. Okay. Okay, let me find that clip. Let me find that clip before I forget. Let's see. Let's see that. Do, 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 do. Let's see. I have 2 clips. I'll play both of these 2 clips if I can find it. Okay. Let's see. Okay. Okay, here's the first one. Yeah, well, space is hard, as Elon Musk says. Space is hard. Okay, let's play this. All right, let me get the other one. Yeah, that was pretty cool. That's pretty cool. This thing looks cool as hell. Yeah, look at that. And I don't know, AI is gonna make that thing for you. This is one expensive firework, bro. So, well, that killed the momentum for the space stocks. Really annoying. Really irritating. Really irritating. Fuck, man. Come on. Okay. Do. All right, let's continue on. Okay, let's see. What are the tickers I want to talk about? I was going to talk about so HPE. So Hewlett Packard is up 30%. I saw after hours, after earnings. So that's good. That's basically like a Dell type move. So that should help us for the rest of the week. People are still juiced up about infrastructure type stuff. So hopefully HUT and all that other stuff will continue on up. Very nice. So hopefully it was already going up, so it's gonna go even higher tomorrow morning. Hopefully it just doesn't crash and burn, and that will give us like the juice to fill up the next leg for the next 2 weeks. So you can see we're already up since the whole March. So it was even going up during March after earnings. So it's been doing quite well, up 132%. You cannot say much more than that. Very good already. So hopefully that money is going to pour into the other sectors. And we're going to talk about some of them. Let's look at AAOI. I think there was some news or something that happened, but maybe there was no news. But look at this candle for this weekly candle. It went down a bit from the close of last week, and then it rallied back up. So it was up 17 to 18% today. That's what you want to see. So if we zoom in, this whole area, that's very encouraging. Very encouraging. That means all the other stocks should be helpful. So after HPE, so Hewlett Packard Enterprise earnings going into tomorrow, we should see HUT and all those guys really rally up. NBIS was up 17% today. So hopefully that's the beginning. So this is kind of like an ugly range, right? I don't know what this is. This was like a failed breakout, pullback. Now this was a failed breakdown, push back up. Maybe this thing will go up tomorrow because of the HPE earnings. Now the other one, the other risky gambling type optical, so that's optical. AAOI is optical photonics. There's another one, ALMU. Maybe I only mentioned it once before, but it's kind of like AAOI. It's just gambling. It's complete. This one's even worse because it has very little history, but it's doing this, right? So if after the earnings of HPE pushes this guy up and this thing breaks out, guess what? We're going a lot higher on this one. So if you want to gamble, you got another guy to gamble with. ALMU. Don't tell me about fundamentals. I don't know crap about this company. I don't know how it competes with AAOI or Coherent or Sienna. One thing to watch out for, Sienna will have earnings this week. So this thing's on Thursday in the morning. This might kill it, right? If this thing has bad earnings, it might kill the moves of ALMU or AAOI. But AAOI, ALMU, high beta, lots of gambling. Those two stocks, you want to gamble, this might be the ones to gamble for this week because those things might go up. If you don't want to, that's fine. You know, Hut and all these other ones probably good enough for you guys. And you got plenty of software companies to look at too. You're I don't think you need to go any further than that. So NBIS up 14%. It was kind of like up 17, 18 during the midday. So it kind of pulled back a little bit. But yeah, that's perfect. We got a breakout here. Okay, so we had a long range here. We moved up. We had a little range over here. We're moving up again. So hopefully it just keeps doing the stair step, stair step, stair step. And then APLD, Core Z, CIFR, IREN. And then I have these two other ones, right? Wolf could be another one to look at. It's trying to break out, trying to WULF. And Rumble. Rumble wants to do AI. So now I have to consider this one as well as a potential. If it breaks out of $10, this could just fly into July. I don't know. So RUM Rumble. So now we're gonna have to look back at CoreWeave. CoreWeave was up today. I don't know if there was news. Was there news? But it was a lot of volume. It looks like it's trying again. So maybe CoreWeave wants to join the party. I know it's the crappiest of them all. I showed you some tweets about the fundamentals of it. It's pretty terrible. I showed you the YouTube with the Canadian. He also thinks this company is very terrible. So, well, we'll see. We'll see. I don't think it's really important to follow this one, honestly, but it could give you something because today it was up 13% on high volume. So let's see if there was any news. Let's see. Any kind of news? CoreWeave rolled out NVIDIA Vera Rubin at production scale. So yeah, there was some kind of news. They just tied themselves to NVIDIA. Fine. So let's look at NVIDIA. NVIDIA was up 6% after it announced the processor stuff with ARM. So not bad. Not bad. So it's survived Friday. It's moved up. It's continuing to move up from this 212 level. Very important. And then let's look at ARM. ARM is just a bubble, dude. ARM is going crazy. ARM is just after this range, it's just whoop. There's really nothing to say about it. Up 16% almost. So those are the winners right now we have. Those are the winners. And Micron hit the target $1,000 a share. Next one is 200. I mean, not 200, 1,200. 1,200 is my next target for Micron for that. Let's see. ALMU I asked about because I read an article playing it because of proxy played to SpaceX. Yeah, I looked it up. It looks like it's a photonic company though. So I don't know. It looks like it's more related to AAOI and the other stuff. I haven't so I don't think it has any supposed direct connection to SpaceX. Apart from that, it's a hype stock, a meme type stock. So yeah, that's about it. Okay, so covered that. Let's see what else. Texas Instruments pulled back, huh? Yeah, so Texas Instruments kind of pulled back. This is not what you want to see. You know, this is definitely not what you want to see, but it is above this level, so I guess it's okay. I don't know. I'm really not too interested in being aggressive in the semiconductors right now because I think the money in the semiconductors is trying to go somewhere else, and we're already seeing it in the software side since last Thursday to Friday. So the end of last week pretty much proves to you that the money is going into the software, right? That's what we expected. And that's something I said was going to happen sometime down the line. I didn't expect it to happen this late, but late is better than never. And maybe software will continue to go up in through July. So even if semiconductors goes down, tries to put pressure on the Nasdaq, maybe the software can continue on most of July. So we have a few more weeks that we can make money on software. And then after software gets tired and gives up, then the market can go down into August. So maybe we'll get lucky, and that's what the future holds. If we don't get lucky, then the market will just puke immediately in early July instead of late July, early August. Okay. So I'm hoping that we can last throughout most of July by hiding out in software, because software, was late. So hopefully late means like it can continue on going one more month. So if it was late one month, then to go up, then it could stay going up into July while semiconductors goes down, keeping the Nasdaq going sideways for the most part. So hopefully that's what I'm hoping for. Hopefully that's what I'm hoping for. Yeah, that's it. What else can I really do? I don't have a crystal ball, guys. I don't have a crystal ball. That's all I'm doing is guessing. Guessing with the best I can, with all the knowledge I've accumulated here, and just throwing it out there. Oh man, so I wonder if I have that. That's stupid. Do I have the? Do I have the blah blah blah? Nope, 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 nope. I'm just looking for a screenshot. Come on, where is it? Where is it? Where is it? It has to be here then. If it wasn't in those two. Okay, yeah, it was here. So these were the two times I was saying like the money would have to go from semiconductors to IGV software. So late February, early March. So this was like during the time when we got like the whole Iran stuff. And I guess the Iran stuff kind of messed things up with that prediction, you know, um, because people just ran back into semiconductors. Like I think at this juncture, towards the end of March, people were like, "There's only two places to hide out: oil and gas." When Trump goes hard on Iran, and when Trump starts going soft on Iran, go back to AI, go back to hardware, because the software stuff they didn't trust. Now that hardware, software has flipped, is starting to flip. Hopefully, this means we can go on for another month. So yeah, so that's what I was expecting. Maybe a month too late, from what I thought it might have happened. I thought maybe towards the end of April it was already flipped, but it didn't. May was still good for semiconductors. It was just crazy. It's just like, dude, going towards the end of April, are you guys really just gonna keep buying Micron? Yeah, yeah, because Koreans don't have software apparently. Koreans only have Samsung and SK Hynix. So I'm blaming the Koreans for this. I think everything after April like 16th, April 17th is basically just Korea. Korea is the one that's juicing everything up in the hardware side of things. And so that's really what's causing the problems here, the distortions. So if you look at the Korean ETF, let's see. So here, you see this? April 16th to 17th, it starts doing this. It starts moving up, but it's reducing its volatility. It's compressing. And then going into May, poof, it just shoots up. Yeah, so I blame the Koreans. It's the Koreans that did it. Like, Koreans don't have software companies apparently. So they have no idea about like software as a service or anything. That's just a San Francisco Bay Area marketing BS that the Koreans aren't into. The Koreans are just into semiconductors. So This is essentially what drove the semiconductors to last a little bit longer than what it should have lasted. Okay, so we have to watch this. If this thing breaks down, we'll know it's over for semiconductors. So keep your eyes peeled. Keep your eyes peeled. Let's see if I have another screenshots of something on Twitter talking about Korea. If there's something important. Nope, not important. That's not important. That's not important. That's not important. That's not important. I don't need to talk about this right now. Okay, moving on. Let's see if this folder has anything interesting. Nope, 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 nope. Nope, 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 nope. Nope, nope, nope. All right. Okay, nothing else to talk about Korea. I think we're done talking about Korea. I'll give you this last bit. So this guy, he's a well-known bear. I remember him. He was all about being bearish in 2022, 2023, going to 2024. If you go to his YouTube channel, Maverick of Wall Street, this guy hates the stock market. He just always bear. I don't know if he's just doing it to clickbait people, because he has his Discord. It's like, if you want to see my real content, you got to pay. So he's got a Discord. Maybe he says something different in his private stuff, but on his public stuff, it's all clickbait. Tons of stuff talking about being bearish to the market. So he's been bearish since 2022. I haven't seen him bullish at all since then. He's been calling for a recession since that time. So look what he says now. All said and done, the South Korean stock market will crash by 80%. The country will face what Japan faced in the aftermath of the 80s: stagnant growth, aging population, and plummeting fertility rates. Comrade Kim will have a solid shot at uniting the Korean people. You have been saying this, you have been saying it for years on your YouTube channel, that the stock market will crash. Yet you have missed out on one of the monumental times in history to accumulate wealth. Yeah, you can see. Yeah. Other people have noticed this. It'd be helpful to update watch lists as time goes on and rank them top to bottom, best to buy, one hut to. Yeah, I don't know. I don't have, like, that's the problem. Like, I don't really have like a ranking. Like, I need the AI to do this for me. Then it's just like, then it'll be better, because loosely ranked, if I just loosely ranked everything, it's just like, dude, it's just a gamble. It's all of it's just like, well, this is what I think, but um I don't know, right? Most of my stuff is mostly to tell you, you gotta start learning how to read the charts and then come up with your own decisions. I think that's the most important thing. Um, Actually, this is probably a good time to take a break. I'll show you this Wyckoff stuff. I want you to get you guys to this level of chart reading. Yeah, once you get to this level, it's really good. So let me give you this uh presentation. So first he talks about Microsoft in the second part I want to show, but there's definitely something else. Something else. Let me see if I finished off everything. Okay, let me do the chart stuff first. Let me wrap up the chart stuff first, because I want to make sure I get to these, and then we'll go to the video. Take a break. I'll take a break. So INOD. If I have time, I'm going to play the fundamentals with that Canadian guy about INOD, because he talks about the fundamentals. But from the chart level, look at this guy. Look at this guy. We got top here, right? Building. You got a gap. You're holding this area, which was previous resistance, support. You're doing well. You break out today. INOD. INOD. So I wanted to talk more about INOD last week, but I'm just like, dude, there's so many stocks now. It's just crazy. There's just so much to talk about. So that's something I'll come back to. If I can't get it tonight, I'll bring it back up tomorrow. Then we're gonna talk about AXTI, right? Let's look at that again. Let's look at AXTI. This is very bullish to me. You see this? We break down. We break down and immediately come back up. So if you think that this is a range of some sort, this is kind of like a range. Like let's be more strict about where the bottom of this range is over here, okay? You see it like penetrated below it and then zoomed back up. That's very bullish. That's very bullish. So AXTI, oh boy. And this red candle over here is probably very important. This one right here. This red candle here. So this red candle right here, right? This thing. It's confirmed that bottom. So maybe towards the end of this week, we can continue on up. So if we look at like the longer term chart, right? Let's look at the weekly. So this was the last red candle. This was the last red candle. This was the last red candle. This is the last red candle here. I'm ignoring this one. I'm just looking at the biggest red candles, okay? Just the biggest. This was the largest of all the big red candles we've seen so far since this year started. So what happens this week? If this thing goes into this red candle, right? Let's say on Friday it closes up here at the top of that range. That's bullish. That means we're going to go higher. We're probably going to go higher. All right. Next one, band, right? Band. We talked about band and we also talked about Twilio. Last night we talked about band. We talked about Twilio. Okay, band went up like 9%. Okay, big whoop. Big whoop. Whatever. Okay, it's got it on Thursday, Wednesday. It tried to pull back. It popped back up. Still bullish. But what did I talk about? I talked about Twilio because I said, band, that company seems like it's a Twilio type company. What happened today? Boom. Up almost 20% on Twilio. Every stock I mentioned last night went up huge today. You could have bought it at the open and went up. I didn't do that, but I'm just saying, right? Everything I mentioned, every ticker I mentioned was like gold. Freaking gold. Like only reason I talked about Twilio is because you mentioned band, and I said like, well, band looks like Twilio because they do the same thing almost. And today it went up 20%. Why? I don't know why. So there you go. There you go. Anyway, but since there are so many, it's hard. I need a system. I need AI to do this for me. This is when I got to be more serious about AI. AI needs to help me. This is why it's so painful because because the market is so volatile, it changes so fast that like by the time I write up something, it'll be over, right? It'll be like, what the fuck? It's already done. The move was already made. It's like I have to be faster. I need help. That means I need AI. Like that's the only way to keep up with this crap. AI can easily just write up reports and things, and like I could just ship it out immediately and be like, yeah, you guys read this in the morning, and you guys can play it the next day. Yeah, Palantir poked its head out. Oracle definitely up. Oracle was really beautiful. You could have did leverage during the day on Oracle because like you see it opened up here, it closed there. So like let's say you're not in Oracle yet, you still had a chance to get in because today, like I can just look at the 10-minute chart. Like you see, it was up here, it went down, and then went back up sideways. So you had 1 hour to get in here before it just rocketed up. You had 1 hour right here before it moved up again. So you had your chance right here to get in. So, and then you had your chance to get in here and here. Yeah, because once we broke out of this range, it was done. It was over. This is over. You have to chase it now. There's no choice. it moves fast. So, but we already talked about Oracle so many times before, so I don't know. Already mentioned it a lot. And Palantir is coming up. Yeah, Palantir is coming up. And we're gonna have to talk about a lot more software companies. Okay, we're good. So let me try to get the video. We're done here. We don't need to look at charts anymore. We're done. Let's get to the video and try to get you guys to this level. I don't know if it's possible to do it quickly. We have to do it quickly. We don't have time anymore. There's no more time to goof around. It's just so damn crazy. This market is insane. This market is so insane. I don't know. Fuck. So let's see. Oh, did I even download it? I might not have, huh? Damn. Okay, I might not have gotten it to it yet. So I'll play the Canadian guys stuff and get you to the INOD. So this is the fundamentals. Okay, so take a break with this, and then I'll go. Yeah, I'll go. Oh, you sold it. Oh man. Shoot. Yeah, that sucks. That sucks. Hopefully you learned something from that one. Okay, let's go. Okay, boring Canadian.
Probably.
Okay, remember that? Remember this? Yeah, boring. This is boring.
Or labor with capital, or capital for labor. This when we have a general purpose technology, a proprietary technology. Let's start there. Proprietary technology usually will lead to an increase in margins, because a company develops some technology that will either lower its costs, so it has revenue minus expenses. It lowers expenses, which raises gross margin. Or it is a technology that creates a product that everybody says, oh, that's really great, but you get monopolist profits out of this because this company is the only one that has it, so it increases revenues, which increase gross margin. So usually that can be captured by the company that creates the technology. A general purpose technology is available to everybody. So you get increased competition as a result of it, and it compresses gross margins. There is a sort of a life cycle to this. That the early adopters, if we think about this being current gross margins, and this is a time over here, that the early adopters tend to see an expansion of gross margins until it starts to get adopted more widely. Then there is a compression of gross margin. And when we talk about general purpose technologies, contrasted with proprietary technologies, proprietary can create a whole new product categories that doesn't replace anything, that simply sits alongside everything else, can create whole new industries that don't replace anything. General purpose technologies replace. They replace something. Railroads replaced horse-drawn wagons. If you wanted to go west to find your fortune, young man, you would get aboard a horse-drawn wagon and you would head out and hopefully survive the trip. The automobile replaced the horse and buggy. The computer replaced a whole bunch of stuff, the most obvious thing with the word processor being the steno pool and the typewriter. Replaced the books for general ledger. The paper books you'd open up and you'd have all your accounting general ledger sheets in there. Well, it replaced all of that. It changed the way publishing was done with desktop publishing, so it replaced quite a bit. The cell phone did a great job in replacing the landline. The internet has done a great job in replacing, or at least displacing, cable, and the internet to some degree has displaced some bricks and mortar stores. The question is, what is this displacing and replacing? When we have a general purpose technology, typically it replaces or displaces proprietary technologies, not necessarily. What is this replacing? And if we say, well, it is going to increase productivity, increasing productivity means the shifting from labor to capital, or as the CEO of Standard Chartered said, lower valued labor. Lower valued labor would go. And that seems to be what everyone is pointing to. I take time and I digress on this topic simply because we're looking cumulatively, if we believe the forecast, $7 to $8 trillion by 2031 on what is rapidly depreciating technology. The big cost in these systems, in the AI infrastructure bill, is not so much the building or the shell, but it's the sheer amount of money that is put into the servers and the GPUs, the memory, all of that stuff, of which has to be depreciated by 2031 almost fully, if not faster. I do believe that you're going to have impairment charges well before then, so some of that money is never going to be recovered anyway, so it's not as if the business models have to recover it all. But if you're putting out $100 billion, you must, as an organization, have some idea of how you're going to recover that $100 billion. What is it replacing? That is the question. It's going to have to get to that level of cost recovery. The belief is that it must be replacing labor. Now, when we're about to go through Innodata, which is an AI data services company, and we're going to get some very good insight into how these models are built, how these foundational models are built, and the ingesting data part.
So place labor.
Is the smallest part of it. The data.
And if you replace labor, I would say like that is the dream of communism, right? Marx was the one that wanted this to happen. Marx said the ideal case is when humans don't have to care about labor anymore. Like the whole argument is that who controls the labor? And once you eliminate labor, you offshore it to robots. That's basically what Marx wanted. So we should have a classless system. If the robots do everything for us, we're all equal again, and we all just have slaves of robots and AI and blah blah blah. Huh. Okay. Interesting. Have we reached the pinnacle of capitalism where we now can go into communism in the correct manner through AI? Was that the whole goal? Was that the goal in the end? Well, I better have a Star Trek type universe then.
Data services that go on after that are much deeper. And I want you to pay attention to one thing in particular when we get there that will make this a lot more salient to you and a lot more obvious, because I've heard a lot of people already mention this. Hey, my organization has given me Claude and is encouraging me to use it. So what do we have in the early stages of the adoption of a general purpose technology is you have initially an increase in costs. So then you have this conclusion of, well, it's not really destroying jobs, it's actually increasing costs. Organizations are not seeing the value of it yet, and you would not see the value of it yet because in your income statement, you're going to have your employee expense, but now you have this new line called a token expense. But your token expense has to be experienced for a period of time before you can get rid of the employee expense. And this is through something called preference learning. I want you to remember that. I want you to remember something about the enterprise customer, because that is a type of customer. It's not just the AI models. An enterprise customer engaged in preference learning. And for those of you out there that say, my company gave me Claude and is really encouraging me to use it, wait till we talk about this. Spotlight company this week is Innodata. Their ticker is INOD. This one took me a while because of the lack of information. It's such a sort of a new field. AI data services. What does that mean? I have a small presentation after this screen. We'll learn about what this space is, and then we'll revisit some financials for INOD, and we'll readjust the adjustments. And it still is a good story, but we want to make sure we're on the right story. The reason we adjust the adjustments is the adjustments can hide a bad story. If after adjusting for the adjustments or readjusting, you still have a good story, you have something here. This is a 2-year chart. Something may jump out at you very quickly. The speed at which the price can go down and the rate at which, the speed at which it can go up and the rate at which it can go down. There it is going up, there it is going down. Up again, big jump up, big jump down, big jump up. That's because of the nature of the business that it's in. Their revenue is contract-based. Very little of it is recurring. They do have a platform business, a SaaS-type business, which is only about 9% of revenue.
So this kind of chart you could see in AOI. AOI is the same problem. It's a contract business. They rely on contracts. Right now, they're in the upswing just because of the AI stuff. Once that AI infrastructure build disappears, AOI will probably just go right back down again. So these companies are pretty fun to trade, right? Very good to try to guess and figure out what are people's expectations. When is the business going to turn? You're going to need a lot of little insights that comes in. So charts might not be enough to tell you. So this is why you're probably going to need some fundamentals in your back pocket to figure out companies like this. So AOI, I would never really trust. And even if I think I could guess where it's going to go, I still probably wouldn't trade it. But if you're a gambling type, this is the stock for you. So AOI and this one, yeah, they're the same type of animal.
Revenue. The majority of their revenue is project-based, and agreements can be canceled on 30 to 90 days notice. It's not as if they're signing five-year contracts here, where we're looking at the size of their backlog. These can be canceled with 30 to 90 days notice. When they get a client, it usually ends up being a big jump in revenue and a big jump in stock price. And when they lose one, it's a big drop in revenue and a big drop in stock price. That's the nature of this space. Not only that, it's a very crowded space as well. When you look at INOD's 10K, they have named competitors. They used to report under 3 segments: Synodex, Agility, and Digital Data Solutions. For Synodex and Agility, they have 8 named competitors, and they say plus many more. For Agility, 5 named competitors plus more. Data Solutions, they name 9 competitors, and then there are 5 more that are within larger organizations that aren't pure plays. So there's a lot of companies in this space, and 2 big threats. When we look at threats from substitutes, we'll see 2 big threats. Digital Data Solutions, that's their AI data services, 86% of revenue for the fiscal year that just ended. They did report Q1 for 2026, and they did now move down to only 1 segment. They did the tests for segments to see if the other two qualify as segments. The revenue is so small versus what Digital Data Solutions brings in. They are now going to report under one segment, and this is beginning with their Q1, sorry, not Q4, with their Q1 2026 10Q. Customers, AI labs, they say, but they're unnamed. Big tech, 5 of the Mag 7, they don't say which 5, and then they have enterprise as well. We will see that for this group over here, they are a more difficult group. I shouldn't say difficult, a more costly group to service than AI labs. A dollar of revenue here has larger margin than dollar of revenue here just because of the selling costs and the customer level of customer service that they require. It's not as profitable as the AI labs. They seem to focus, big tech and enterprise seems to be where their focus is. A market cap of $3 billion, fairly small. Fiscal year 2025 net income $32.2 million, and their Q1 2026 net income was $14.3 million. So you can see that they've got a step up in revenue. This is only one quarter, so if you annualize it, you're getting to $56 million, although the forecast is for greater than 56 million from 32. Gross margins, Synodex 18%, very, very tight gross margins. Agility 54%. This is the one where they're focusing 39%. It's quite common. Roughly about 40% margins is about the average in data services. If you have a platform, you can usually get SaaS type margins much higher than this, but if you are in data services, especially in the category called execution, this is where they're sitting, that's usually about the margins you're going to get. So they're right in there with everyone else at 39%. They want to point to their adjusted margins, saying, look how great our adjusted margins are, but what they're adjusting for should not be adjusted, so we're going to readjust them. Synodex engaged in medical records, data extraction and transformation. They have 15 customers, and this is as of the end of fiscal year 2024. I find no information past that. Agility PR Solutions is a platform for public relations. If you look at its revenue as a percentage of the total, it's something that can be ignored. It's so very, very small as to be an afterthought, as to, why not just get rid of it? Also, they mentioned they are in development for AI-enabled platform for financial services institution. However, when you get to their latest 10Q, there's no mention of that anymore. They mention everything else that they're working on, but that has simply just been dropped. So I don't know if they thought it was a good idea and then said, you know what, we don't have the expertise for it and we can't get the expertise, or if they decided, let's just keep it quiet and not talk about it. But there was no mention of it in their latest 10Q. This sort of gives us a high-level idea of what they're doing, but when we say AI data services, digital data solutions, what does that space look like? Because it does matter what you do. And it does matter where you sit in your data services. Are you doing pre-training? Are you doing preference learning? Are you doing safety and evaluation? They all have different margins. So it is useful to figure out what exactly does data services mean? What are the types of data services? And what are the types of companies that claim to be data services? Because some of them are really just marketplaces. So you have some that say, listen, you need experts, right? And we are a marketplace, and we have all the connections to all these experts. And here they are in our marketplace. And you can contract directly, and then they have what's called a take rate, where they say, okay, it's $300 for a PhD mathematician. And they'll pay the PhD mathematician usually about $240. 60%, $180 per hour. 60% would flow through. Their take rate might be 40%. So they actually don't do anything other than say, listen, we have 30,000 experts in our database. If you want access to our database, sure, and you can contract. You won't know who these people are because they're just profiles, and you could say, I'll take these 10 people and we'll arrange for it. You tell us what they want to do, we'll send it on to them, we'll finish the finished work to you, and then they take something in the middle. They don't actually do any data services themselves. So, but they're still in the space of data digital solutions. So let's take 5 or 6 screens. Let's get to know the industry, and then we'll revisit InnoData. Okay, I have a number of screens that look like this, lots of words on the screen, so I'll naturally go very quickly through this. It is drawn from a document I produced, which is up on Gumroad. The link is in the description box below, called Understanding AI Data Services. This one's a long one. It's about 160 pages. This one took me about 2 weeks to get done. And again, is because of the sheer lack.
Bruh. This guy wrote this whole crap for 2 weeks, 160 pages just to understand this stock. What does this company really do? Apparently, after listening to that, I don't think this company actually does anything. They just stuck a bunch of AI in their whole freaking thing, and the people think it's an AI company, I guess. Is that what he's gonna say? I bet you if I just skip through this whole thing, he's just gonna say, like, this has nothing to do with AI, probably. This company has nothing to do with AI. So if I just look at the chart, well, it's tradable. If I look at long term, maybe this company is just a bunch of fugazi that's gonna go down to zero in a couple years, because what I've heard so far is essentially there's nothing to do with AI. They just have a bunch of people that claim to know things. So I could be on their profile, right? I could just go on their marketplace. I'll be like, I have a PhD. So if you pay me $100-something an hour just to help you talk to somebody else, like what does AI have to do with anything? What?
Of information available out there, you have to go through a whole bunch of companies' 10Ks to start extracting all of the information and then start organizing it. So I did the best I could here. AI data services, said bluntly, it's the set of activities that do all of these things. You produce, you curate, evaluate, or manage the data that AI models require at any stage. And depending on what you're doing, this is the higher margin one, evaluating and managing. Producing and curating is sort of bulk work and very low margin. When you look at the companies that you have, all of them will explain their workforce, how many employees they have, and geographically where they are. When you start seeing places like low-wage places, more than likely they're engaged in this kind of work, especially if we have a lot of employees that are sitting in Africa. More and more the Western countries show up.
Wait, what? What does this have to do with Africa? Why did he mention Africa there? It was just like, oh, low wage employees, Africa.
In evaluation and management, and more India is there as well. So we can't think, well, I see a lot of employees in India, it must be low quality work. It may be low cost work, but still high quality. But Africa is a dead giveaway that you're working at the lowest value tier of AI data services. Why should these companies even use external companies? Aren't they the pros? They require specialist knowledge, which is typically external to their core workforce. That means legal, medical, financial, and these AI companies, the OpenAIs, the Anthropics, they don't really have that internally, although OpenAI has said they've hired 100 ex-bankers to take care of financial modeling. We heard that about a year and a half ago, about a year ago, and haven't heard anything about it since. Maybe it was just a headline, I don't know. Also, the demand is intermittent, is that this is not an ongoing thing. A model goes through stages, and then it's recursive. It does recursively go through these stages, but at no time do you need one stage all the time.
So I'm starting to get worried now, because if everything is based on like what kind of information you get, you got to be worried, because you know that a lot of information comes from GitHub, right? So a lot of stuff is stolen off of GitHub and Reddit. So let me show you this. Let me show you this tweet here. Oh, so let me find it. All right, so where's all this data coming from? So where does AI get its data? 40% comes from Reddit, 26% from Wikipedia, 24% comes from YouTube, 23% comes from Google, 21% comes from Yelp, 20% comes from Facebook. Yeah, Facebook is pretty solid, right, for information. 18.7% comes from Amazon, 12.5% comes from TripAdvisor, 11.3% comes from Mapbox, 11.3% comes from OpenStreetMap. And now I'm hearing all this shit comes from India and Africa. Okay.
So because it is intermittent demand, these companies don't want to hire 5,000 people, then lay off 5,000 people. It's easier to get a third party to get that done. Geographically disperse as well. You're just not going to get the number of experts you need in one country. You're usually spread around the world. And independence. This is for regulatory and customer acceptance reasons, especially for the safety of the model. Categories of AI data services demand pre-training. Pre-training data preparation, collection. This is what we've done here, the production and curation. Collection, cleaning, deduplication, quality filtering, and sometimes licensing. That is the curating part. Licensing of source content. This is about 2 months of getting this done. It's very mechanical, low skill, high quantity, low margin work, very project based. Typically your employee crew, again, as I said up here, is primarily from Africa. These sort of go together over here. Supervised fine-tuning, producing curated examples that demonstrate desired model behavior, shows the model thousands of examples of well-formed responses to well-formed prompts. The quantity of work here is lower because you're just looking at thousands of examples, but quality is the big thing. This is the first screen that any vendor or any customer would look at in terms of the data service providers, is the level of quality that they can produce. If they don't match a minimum level of quality, then it doesn't matter what their price or what their speed is. That is number one. Quality is much higher. Specialized labor require premium pricing. And again, it's still project-based though, about 5 months. So that spans, 2 quarters. So you can get a contract in 1 quarter and yay, everything looks good. And the next quarter looks good. And then boom, you've lost it for the next quarter. And that's why Data's chart shows that kind of pattern, is because this is very project-based. Preference learning. Reinforcement learning from human feedback. Sometimes you'll see this acronym RLHF, reinforcement learning through human feedback. Producing data that teaches the model what humans prefer when multiple plausible responses exist. How many times we're using your AI and it said, hang on a second, which do you prefer, A or B? I do get that quite often, but the nature of the work that I do, maybe the model says, hey, this guy is as close to an expert as we'll get. Why don't we outsource some of the work to him as opposed to using a data services provider?
Oh, he's basically saying that oh my God, you are the product, right? That's the whole game. It's like, oh, well, we'll give you this AI for a few bucks per month. We give you a good deal. Well, the only reason they're doing that is because they think you're a good way to validate their models. So they're using you to clean up their mess. Right? It's like whatever the Africans came up with, the Indians came up with, you are the guy that's going to be like, well, I like this answer better than that answer. I like this answer better than that answer. Oh my God.
And I may be inadvertently helping the model become better. typically runs concurrent with supervised fine tuning. Now we do have RLHF. There is RLAI as well, reinforcement learning from artificial intelligence feedback. So synthetic data is becoming, as the models become more powerful, you get synthetic data. So some of you may be thinking, well, isn't synthetic data a threat to the business model of companies that are providing supervised fine-tuning and preference learning? Yep, it is. But there's another bigger issue here, and especially at the enterprise level. And this is specifically in preference learning, is let's say that I'm a large bank like a JP Morgan, and I can outsource to a particular company. I'm an enterprise company, and I can go to one of these data services places and say, can you, on top of, let's say, Claude, we're using Claude, can you give us something very specific for financial legal help to sort of capture the decisions that are made there, that the bank may say, you know, wait a minute here. Why are we using you? We have, I don't know, 400 lawyers throughout JP Morgan already. What if we gave them Claude and we captured their input and their output? Because they're free to us in a sense, because we're already paying them for the work they do. And when we talk about the output of labor, there's a particular name for that. The output of any organization is called exhaust. Much like a car engine's exhaust, it's called business exhaust. If we capture that, aren't we getting our own preference learning done? So one of the bigger substitutes that we'll see later on is the work going in-house. One sure fingerprint within an organization that the organization is doing preference learning in-house is if it gives its staff an AI to use and pushes you to use it as much as possible. And I've heard some people say that my company gave me Claude and is encouraging me to use it as much as possible. It's not because it's trying to get more productivity out of you. It is more likely because it's trying to get preference learning out of you to eventually replace some of you people. That's the goal of this thing, right? Because remember what we said about a general purpose technology. It tends to replace or displace. Well, what is this thing replacing? If you are being encouraged to use an AI within your organization, chances are it's not to increase your productivity, but it's to engage in something called preference learning, reinforcement learning from human feedback. You're the human that is reinforcing the ability of the algorithm to eventually replace you. But JP Morgan can't tell you that's what it's doing, right? Let's keep going. Evaluation and red teaming. Now, I say that not to make some point about AI is going to destroy jobs. I think we know that some jobs are going to disappear because of AI, because you have to justify those budgets. I'm saying it because it's a very real threat to the industry of companies that are providing digital data services. That if enterprise customers say, wait a minute, though, we have our own experts. That's the high margin. The supervised fine-tuning, preference learning, this is high margin stuff, right? You lose that, what do you got? You got this low margin stuff down here. Evaluation and red teaming. This is where you try to get the model to do bad things. You push it to come up with mistakes. You push it to do things wrong. You push it to do things dangerous. Testing trained models for capability, accuracy, safety, and adversarial robustness. There's about 3 months worth of work. You got 2 months here, 5 months here. You move on to 3 months. Again, these are all very project-based jobs, and so revenues end up being very lumpy. High margin, specialized labor. This ends up being more recurring than project-based, however. Continuing on still with categories of AI services. Agent training environment, data to creating environments. As the current frontier of the sector, typically runs in parallel with the previous stages. Constructing environments in which the agent can act, You observe consequences and learn from feedback. It is small right now, but is growing. And synthetic stat generation, data generated by AI models rather than produced by humans. It also used at all the other activities as well. It's used in conjunction. It's not as if it's separate. It is being used in conjunction with everything else, because it's the idea of you use synthetic data with real data. As long as you have a human in there, the human can evaluate the synthetic data. So the AI model produces the data but does not evaluate the data. It is seen as more right now more as a productivity booster, not as a replacement for humans. But when the model, and it's a question to ask, when a model gets to the point where it can not only produce but then evaluate its own data, is this industry just sort of a melting ice cube? Different vendors specialize in different stages in OData.
So I guess like we're just going in a feedback loop at this point. Yeah, I don't know. Yeah, that's a dead internet theory, you know? Dead internet theory. Everything's bots, everything's nonsense, everything's advertising too. A lot of so-called news is just a veiled advertisement right now. So it's just nonsense, complete and utter BS. Yeah, we're stuck in this game. So I think this will just implode on itself. Everything will just collapse, right? We're just building these huge like towers of of playing cards, and it's just gonna fall over each other. But in the meantime, we can still trade it. I just don't know if this company in particular, INOD, is like the one to really play this game, you know. The chart is interesting, but I could see like, yeah, you could get trapped pretty easily. But it already reported earnings, so we'll be fine until the next earnings cycle, right? But this is something to think about, because I think this is not something that is only applicable to INOD. I think every AI company is going to run into these problems pretty shortly if we get everything from Reddit and all that. Okay, so let me go down here. Let me read a little bit for you guys, and then we'll go back to the next video, and then I think we'll wrap it up from there. I just want you guys to read charts. I don't want you to get too much into the nitty-gritty of fundamentals, but it will help you explain why the chart moves as it does. And then the software companies kind of have that effect too, right? They're kind of binary. They go up in the one earnings, they go down in the next earnings. They kind of have that thing too. So they all have this kind of issue. So I was asking, you know, Gemini or whatever, Google, about financialization. And I said, like, okay, just give me the definition of financialization. This is important because this will explain to you why we're going to have these big bubbles, right? We have already a big bubble in the real estate market in San Francisco, and it's probably going to spread to other places. We're going to have places where it's just going to be like all this money is sloshing around. So financialization is the process by which financial markets, motives, and institutions increase in size and influence over a country's economy and society. It marks a shift from an industrial economy where wealth is generated primarily through manufacturing goods to one where profit is generated heavily through financial transactions and engineering. So this is where you're going to get a lot of problems. So I don't want to be coming off as a communist, all right? But this is exactly why you're going to have a lot of wealth inequality going forward, okay? We already know that wage growth now is negative, all right? So if you didn't know that then, you should know it now. It's official from the government statistics that your wages are now decreasing in terms of real money. So you take into account inflation, you're actually your wages are now officially decreasing. If you live in a blue state or a blue city, obviously you should have known that already, that your wages are not keeping up with inflation and it's actually decreasing. So even if your company will give you a 5% raise next year or whatever, it's not keeping up with real inflation. Let's be real. Okay, rise of financial motives. Corporations prioritize short-term shareholder value, stock buybacks over long-term capital investment and research. Securitization, explosion in the creation of and trading of complex financial instruments, repackaging debt or assets to be sold to investors, like we see today with Google and Berkshire Hathaway. So Berkshire Hathaway sold a lot of stocks, Visa, MasterCard, a bunch of stocks um, last quarter. And I guess now we know where they put their money in. They're going to buy Google shares instead. So they put out into T-bills to cash. So they get their nice little 3%, whatever, 3 to 4%. And now they're also getting into Google shares at a discount because, as you know, Warren Buffett doesn't buy things at the correct price. He likes to buy things at a discount price. So he only accepted that deal because Google is offering him those shares at a discount. Everyday intertwinement. Individuals are increasingly drawn into the financial system via defined contribution retirement plans like 401ks, mortgages, and personal debt, shifting financial risk from institutions to individuals. So this is going to be important because I'm going to talk about this article now, and then I'll go to the video. Okay. So, and we'll wrap it up then. I have a lot of articles to get through, but I think this will be very important because this was just released over the weekend. Okay, you know SpaceX IPO, right? Well, we know the investors will sell their shares, right? Right, within the lockup period, so they can sell it earlier. Well, guess what? This mutual fund lets you buy SpaceX stock before the IPO, but what are you actually getting? So here we are. We have some problems right now. Okay. So we already have this issue here where you can get these SpaceX shares beforehand. Now, so that's one thing. So people are already running into SpaceX. Now, there's another problem though. Okay. There's another problem. So let me get this one if I can find it. Oh, marketplace. Okay. Let's see. SpaceX. Oh my God. SpaceX. Okay. Okay, retirement plan. Okay, let me see. Blah 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 blah. Let me find it. Okay, over here. Okay, this one's the very important thing. Okay, so you saw this one. Well, so we got a mutual fund that lets you get SpaceX early. Well, this is worse than that. Here we go. Elon Musk's SpaceX IPO could quickly launch into your retirement plan. How? How is this happening? Oh my God! Now I have to get. Is it behind all? Oh man, it wasn't behind a paywall last time I read it. Oh my God, piece of crap. Okay, I found a non-paywall one. Oh man, these people so annoying. Okay, I got to go to AOL to get this information. You motherfuckers. Elon Musk's SpaceX IPO could hit popular index funds and your 401k in as little as 5 trading days as index providers relax their rules. So you remember, there was a rumor that they were going to allow SpaceX, Anthropic, OpenAI to be put into the S&P 500 and the Nasdaq immediately. Usually they would wait many quarters before they decide to do this. But because all of them are trillion-dollar stocks, they can't wait to put them in the S&P 500 and Nasdaq. And so mutual funds, the index, everybody is going to get SpaceX, Anthropic, whether they like it or not. So even if the insiders sell their shares, buy San Francisco real estate, the stocks won't drop. So this is the thing here. I think this bubble can last well into next year just because of this. Just because all you dumb boomers don't look at what's happening underneath. You just trust them. to buy you shares of whatever. They pick whatever they want in their mutual funds. They're going to dump a bunch of SpaceX in there just to keep it from going down while those insiders sell out. You got played, guys. You got played. You're going to be all part of this bubble. Oh my god. I can't believe this rope-a-dope shit keeps happening, man. You guys never learn anything. All right. Elon Musk SpaceX is going public at a valuation north of $1.75 trillion. And if you hold a broad index fund in your retirement account, which everyone probably does, you're likely to end up owning a slice of it, whether you buy a single share or not. For many savers, the first fund to pick it up won't be a famous tech fund or even an S&P 500 fund. It'll be a plain total market fund, possibly within 5 trading days of the IPO. Your retirement is all based on SpaceX to keep going up. Yeah, Reddit's in a range, but it's like it doesn't have much history. I don't know. I don't know if I want to gamble on that thing. So yeah, you could trade it. I don't have an opinion, really. Surely the culprits will be brought to justice. No, they won't be brought to justice. You just got to make money and get out, dude. You just got to get out before everyone gets the rug pulled on them. That's the result of index providers relaxing rules written more than 2 decades ago. Yeah, there was a reason they have these rules. Specifically to keep unprofitable, unproven companies out of the funds millions of Americans rely on for retirement. SpaceX hasn't turned an annual profit. Oh, yeah. Anthropic hasn't either. Oh, yeah. OpenAI hasn't either. It's about to enter the indexes anyway. Here's how that happened, what it means for the money you've already invested and what your opinions actually are, or your options actually are. Blah, 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 blah. Yada, 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 yada. Why index funds couldn't buy unprofitable companies until now. After the dot-com crash, index providers tightened their emission standards. In 1999 and 2000, flagship benchmarks scooped up richly valued, money-losing companies near the top. Yeah! So you just want to have the dot-com bubble happen again, aren't you? So here we are. Let's do it then. You want to do it again? Then I better turn my millions of dollars into billions of dollars because you guys want to do this game again. You guys didn't learn your lesson. All right. And ordinary savers in passive funds paid the bill when those names collapsed. So the guardrails went up. To join the S&P 500, a company had to have traded publicly for at least 12 months and posted consecutive quarters of GAAP profitability. Okay. Look at this. GAAP profitability. GAAP, accounting standards. You know, most of these software companies don't even do that. They do non-GAAP. Everybody doesn't even listen to these rules anymore in a stock market anyway. They just like make up their own accounting rules. And that's why you have this boring Canadian yell and scream and talk about like you guys are making up accounting like Fugazi and like making me have to do all this homework and show that this is all bad, but it doesn't matter. Stock market still goes up anyway. Index providers also set minimum float requirements, a baseline share of stock that has to be freely trading because funds need enough available shares to buy and sell efficiently during rebalancing. Okay, so if SpaceX doesn't have enough shares and these guys are just going to jump in after 5 days to buy up SpaceX, that thing is just going to go up like crazy because there's not enough shares out there. Oh my God. Those rules held for more than 2 decades. Tesla, Musk's other company, traded publicly for over 10 years before it finally cleared the S&P 500's profitability bar in 2020. Oh, righty. Oh my God. Yeah, we're screwed, guys. This is bad. Anyhow, okay. Let's go back to here. So I asked, the AI, I asked like, what's financialization going to happen in the AI era? Financialization in the AI era represents massive shifts. Okay, what the hell is that? Massive shift where technology strategy, personal money management, and the global economy. Corporate definancialization versus data financialization. At the corporate level, the adoption of artificial intelligence initially promotes a definancialization effect. Companies are reallocating capital away from traditional financial assets like stocks and bonds and channeling it into into productive high ROI, so return on investment. Research and development AI operating systems allow CFOs to reduce delivery costs. What? And automate up to 70% of repetitive workflows. Yeah, okay, ideally, shifting human workers to strategic roles. However, at the macro level, the underlying drivers of AI, specifically massive graphics processing units. So this is all from this Economist article. All right, and compute power are now being financialized. Yeah, this is the problem here. So we were reading that last night with Michael Burry with his crazy chart, and he was saying like, "Yo, you put your GPUs in a retirement fund, bro." Okay, so if Wall Street is racing to build derivative markets and collateralize computing power, much like it did with oil and housing. Okay, so that's the problem. Okay, let's go down here. Systemic risks. All right, so and market instability. As AI driven algorithms and alternative data sources begin to dominate capital markets, there is a risk of highly synchronized market behavior. When thousands of algorithms react to the same data at the same time, the potential for flash crashes and systemic instability increases. Therefore, furthermore, the rise of AI generated deepfakes enables highly targeted scalable financial fraud. Yeah, yada yada. All right. Okay, so I don't know. I don't think there's enough information right now for people to really fully understand the problem. Yeah, I just asked it some more about mercantilism and capitalism. I think like, we kind of are moving back into the feudal era of things, you know? Like the reason like you had the US 1776, and then you had like Adam Smith write The Wealth of Nations around the same time. You kind of can see like parallels where like people wanted to break away from the UK, like the empire, because all they did was drain resources towards the motherland. And so if you look at AI, it's kind of the same thing, right? Where now everything is being drained, all your labor, your free labor, because they're using you for free. You think you're getting a good deal by using their AI, but they're actually extracting your free labor now into their whole coffers right here. And so you can think of like Facebook, Google, Microsoft, OpenAI, Anthropic, all these guys, Amazon, all these guys are essentially just are like the new feudal lords. They are the new power centers. It's not like colonialism in the traditional sense. So I think we're kind of getting back into this whole thing where we're going back to mercantilism, right? And then if I look at Karl Marx, I would ask like, so I asked AI, what would Marx think about AI replacing labor from humans? And then we got down to here. So let's look at this part here. Let's look at this part. So Marx used the term general intellect to describe humanity's collective accumulated knowledge, science, and technology. In the AI era, this collective knowledge is patented, monopolized, and privately owned by a handful of mega corporations. This creates a new technological aristocracy that controls not just the means of physical production, but the very infrastructure of information and knowledge. So we have a chance right now, right? So do you want to fight the system? You want to fight the system, or you want to be part of the system? You want to fight the man? And I think this is where we're headed here. Because we could be free, right? We could just do our own AI ourselves and do it outside the whole Microsoft, OpenAI, and Anthropic. Hmm. This will be the problem. This will be the problem. Marx ultimately saw automation as a necessary stepping stone toward a liberated socialist future. In his view, the problem isn't the technology itself, but the relations of production, meaning who owns the technology? Well, not me. If AI were democratized and collectively owned by society, rather than, so this is all Reddit. You see here? It's getting its information from Reddit. Whoever commented on this Reddit thread gave us this answer. If AI was democratized and collectively owned by society rather than private tech monopolies, Marx would argue that it holds immense emancipatory potential. By automating mundane, grueling work, AI would drastically reduce the necessary working hours for everyone, freeing humanity to pursue creative and scientific. Yeah, this is Star Trek. This is Star Trek. All right, that's Star Trek. Okay, yeah, okay, I got you. I got you. That's the dream. Yeah, if you're gonna get there. So I'm really skeptical now. I'm getting very skeptical after listening to all that video and doing my little Google search here. I'm very skeptical about all this. The Pokemon Go. Yeah, Pokemon Go. Yeah, I remember that. Yeah, I remember that. Yeah, it's a game, right? That game might have been just for people just to map out stuff. So Jesus, everything's crazy. All right. Let me get rid of this. Okay. Okay. I'm done. All right. So, I want to play this video for you. So, we'll wrap it up with this one. Oh yeah, they recently came out. They compiled all the scanning data and sold it. It's just like the 23andMe, 23andMe scam. Yeah, that was a big scam. Suckers. Oh man, there's no audio. Damn. I gotta do this game again. Okay, hold on. Hold on to your pants. So let me play something else while you wait. Let me play something else while you wait. Oh, it's the audio. Oh, he just muted. Okay. I heard something. Okay, let's go. Let's go. Come on. Come on.
17, 18, having so much profit, and then just
Okay.
I see where
Okay, so you see this ASTS?
STS.
Okay, ASTS. He's gonna talk about ASTS over here.
Uh, 17, 18, having so much profit, and then just losing some of it on the way down. So the psychology of it here is just to sell on the way up, on the way up. So I keep consistently taking profits in the current environment. I don't care if it's gonna go higher. Absolutely don't care. I'm just want to be in the momentum stocks and kind of like keep doing what I'm doing. So this is an example, ASTS. I mean, obviously associated with the SpaceX IPO. So what happens there? Everybody's expecting IPO, and the valuation of the IPO is so high. It naturally lifts other space stocks, up. So a quick options momentum trade that I did right here. I exited on this bar right here because of the volume signature, similar to this, and similar to, where is it? Oh yeah, right here. This. So why am I exiting? You might say, like, so early. Well, first of all, it's an options play, so you play options in a different way. And secondly, I'm just a technical trader, so I see where opposing forces coming in. So those are the bars. Do I want to stay in this position for the exhaustion of it? Even though this is stronger, the latest case, probably not. So I don't care about the last like two up bars, even though they might bring more profit, right? But why would I do that? I could go to other stocks and pick up the same type of setup somewhere else, which I did. So with that, that was a sweet trade, made like 200% on that on options, maybe even more. I don't even know. So this is the type of the play that I'm doing right now in this environment. So I'm utilizing a lot of like momentum of the market.
So that's what we're doing, right? We're just going around trying to dance, trying to find a new girl. We're in a dance right now. We go to space stocks, you go to like the infrastructure stocks like Hut, whatever. We move on to something else, software now, and we're going to keep dancing. We're going to keep going, right? The first software stocks that went up a lot were the cybersecurity. Now it's spilling over to the other guys. Maybe at the end of it, Adobe actually finally goes up a lot, and then that's the end. That's the final. That's the final dance partner. Adobe is the last one. The trash at the bottom. Adobe, Sentinel One, whatever. But we have to keep going. So that's the thing. Is like you have to find a new person to dance with. If you wait for the final end to trade, you're taking a big risk, right? The final.
So there's going to be a lot of people.
Sorry, the mic went off, but yeah, I was talking about Adobe or whatever. Yeah, I don't know. Who cares? Like the garbage stuff, the garbage software companies will probably be the last ones to go up. So yeah, who knows? Who knows? The money keeps flowing. Once we get to that point, it's probably be the end, the final straw. Micron will be really the one to watch. We have to watch Micron, what it does. If the Koreans and the Micron just implodes, we have to be worried. But hopefully that doesn't happen. Hopefully that doesn't happen. Anyhow, yeah. Oh my god. Okay, so continue on. Next one will be he goes over Microsoft, and that'll be the end of it. We're done for tonight.
I look at the chart. Do I see a signal for
Okay, yeah.
the post-trade analysis just for intraday trading? So if you were to ask me maybe like 3 years ago, what's my daily process, I would go and I would say like, yeah, I'm getting up like at 6 in the morning, my time. I already prepped from yesterday. I have specific things that I need to do, like go through the daily, then to the global of 1 hour, 30 minutes, then go to the pre-market structure, then go to the open, then go through the first 30 minutes of data, and then just to see this and this and this. And that would be all correct, because this is how we all learn. This is how we all need to process things. So we created the whole course on trust the process. You could check it out on our.
So he goes over like his routine and whatever. He basically says once you do it enough times, you kind of get the rhythm of things. So this here, he gets asked about, well, how you look at Microsoft though.
You have in this information, in this data, you just need to create a system behind it. But we don't need it, like us, Wyckoff Analytics, with chart reading or Wyckoff method. You just see it on the chart. You see an accumulation behind, let's say, like this. What does this bar do? That's demand coming in initially and absorbing whatever supply is available here, but supply is still dominant, so still to the downside. But now supply starts to deteriorate. Then you have a pocket, a cumulative pocket of demand coming in on the way down. They're buying, that depletes selling so much, and then they're buying again. And then horizontal reaction, whereas from the same place, we are actually going down. So that's strength, more buying coming in, more depletion of selling on both of the reactions with the consecutive higher lows and increased spacing. ease of movement. So I mean, like, it's all so basic. It's also
I mean, it's basic if you keep doing this all day and keep staring at charts. That's the whole goal of the game, right? I need you guys to just keep looking for the patterns, looking for everything. And maybe tomorrow we'll talk about this guy's book. His book, I mean, not his book, his mentor's book. Trades About to Happen by David Weiss. Okay, David Weiss. Maybe we'll go a little bit into it. All right. And maybe that's going to be more clear. It's only one indicator called the Weiss wave. So maybe you guys can look it up yourself. Weiss wave. Okay, it's called Weiss wave. Look it up. I'm sure you can go to TradingView and you can find a bunch of people that have different versions of the Weiss wave. Okay, and you can go and look into the documentation and find it and see how they use it to look at this stuff, because that's his mentor. That's how, when he talks like this, it's essentially the Weiss wave. That's what it is. Okay. And there's other people with videos about the Weiss wave, and I think there's another name they call it, like the volume wave or whatever, the Wyckoff volume wave, whatever. They have some other names for it. So that's very simple. It's a very basic concept once you get to know it, but he doesn't talk about it like that. He just kind of like is open to interpretation, because if you use the Weiss wave, you're restricted into determining what is the leg, right? What is the up and down, kind of like the DeMark, right? Where you can do the 1, 2, 3 with the Elliott wave stuff, the Elliott wave type of thing with the DeMark counts. And you have the 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. I think if I combine that with the waves theory, maybe I can combine those two things into my own thing. I take the DeMark and I take the Weiss wave and I put it together. Maybe that'll be more interesting. I don't know. I just have ideas though, but I really don't want to go down that route, because then everything will be like, oh, I have to make an indicator. And then if I have to use an indicator, then I have to buy an indicator and sell an indicator from someone else. It's proprietary, right? DeMark is proprietary. I could make a dumb version of DeMark, which people have done on TradingView, and then use that and try to make one up for myself. But yeah, we'll see. We'll see. I don't know. That's going to be a lot of effort, and maybe the AI will help me code it for me on TradingView. Okay, AI, give me the DeMark. Give me some DeMark code, and then put this Weiss wave in there. Generate some code for me, and let me see what happens. Yeah, maybe I'll do that. But that's for the future. For now, just try to understand what you're looking at, because even if I can make AI generate code for me, it could give me garbage. Your job is to be able to do this without AI, so you recognize when AI helps you out, you can catch the mistakes that AI will probably do. Okay? We've already seen a lot of issues with AI. It can't spell, okay? It can't count. It gets tired. I think AI might rebel pretty soon. And yeah, so tell AI to read the DeMark algo and see what it spits out. The problem is it's all proprietary. The DeMark stuff is proprietary. I have the book, which is an old version of the DeMark stuff. So that's how DeMark makes money. DeMark makes money is because he makes everything proprietary and trademark. He will sue you. If he sees you take his shit, he'll sue you. He doesn't play around. He has an army of lawyers ready to go to sue your ass. He's taken down a lot of people with the DeMark stuff. He trademarks everything. Everything he has, he puts his name on, right? DeMark this, DeMark that. It's all registered, trademarked. So it doesn't have to be patented. It's just trademark. So anybody that uses something that looks like whatever he uses, he's gonna sue your ass, man. That's it. He's done. He's done it before. He'll do it again. So yeah. If I come up with something, I can't call it DeMark. I'll have to like make it like something, call it something else. Yeah, we'll see. But yeah, that's how it's gonna go. All right, guys. See you later. We'll see what happens tomorrow morning. Maybe I don't know what the hell Micron is doing. What the heck is Micron doing? Is Micron even? Micron is probably the most important stock right now to watch what it does. If this thing just blows up and doesn't go up to 1,200 tomorrow, then yeah, maybe that's the problem. But if the money goes into Korea's down 5%. Korea's going down, baby. Korea's going down. So maybe semiconductors is over. If semiconductors is over, go to software. Go take that money to software.